Hi guys, Ben here and welcome to Motivation to Invest. Our mission is to motivate you to invest for your financial freedom by providing you with valuable investing tips and strategies. Now I've received a number of questions from you guys asking which is better, dollar cost averaging or lump sum investing. Say for example you have a lump sum of cash and you're wondering, shall I invest it all in the stock market in one go? Or shall I spread it out and invest a little bit every month? So in this video, we're going to explore what previous historical studies have shown is the best way to invest in the stock market and deploy your capital. Let's dive in.
Coming in, flex, I just wanna win.
Before we get started, go ahead, smash that like button and subscribe if you haven't already. Be sure to turn the notification bell on, that way you'll get notified when I release future videos and stock picks. It's good to be first on the scene when an interesting stock is at a great price. So what is dollar cost averaging? Well, dollar cost averaging is where you invest a consistent amount every single month, regardless of the market conditions. This could be a portion of your paycheck which you get from your job every single month. The idea behind this type of investment is to average out the price you pay for the stocks as you're investing in them during a variety of conditions. For example, let's say you invest $500 from your paycheck every month into an index fund such as the Vanguard S&P 500, which is the top 500 largest companies in the USA. So this £500 automatically gets transferred into the index fund every single month. Now when the stock market is cheap, that £500 will allow you to purchase more shares of the fund. And when it is expensive, it will automatically allow you to purchase less shares. Thus the price you pay for the stocks averages out. Also the fact that you can set up this fixed amount to go directly from your bank account to the investment account every single month is a great advantage of dollar cost averaging. This is because firstly, you don't have to think about the investment. It's very easy, it's very passive. Secondly, you can set it up in such a way where psychologically you will never see that money enter your account. Thus you won't start thinking about, oh, what shall I buy with this extra money I've got in my account? You won't see it, thus it's automatically invested for your future. This is a great way of investing for those who want that discipline. As many studies have shown that when people get a pay rise, they automatically spend more and thus their expenses increase rather than invest more, which is the right thing to do. Dollar cost averaging also works out great if you don't have a large lump sum of cash to invest today. As the great Warren Buffett says, time in the market is greater than trying to time the market. And as the old Chinese proverb says, the best time to plant an oak tree is 100 years ago, because today it will be fully grown. But the second best time to plant that oak tree is today. Thus, the earlier you start planting those investing seeds, the faster you will start to see the magic of compound interest at work. So is dollar cost averaging the perfect system? Well, many think so, but surprisingly, lots of studies have shown that lump sum investing is actually better and can give you much greater return. This makes complete sense, as with lump sum investing, you purchase a large amount of shares in one go. Thus, your time in the market is longer. For example, during the previous stock market crash in 2020, I saw the market drop to very, very low levels. Thus, I used the lump sum investing strategy to deploy my capital into the stock market, taking advantage of the low prices, which gives me a margin of safety for my investment. Now, various studies back up the fact that lump sum investing can offer greater returns. That is, of course, when you have the lump sum of cash available to invest initially. The Vanguard study states, on average, an immediate lump sum investment has outperformed systematic dollar cost averaging investment strategies. This conclusion is consistent with finance theory, as your capital is exposed to the historically upward trending markets for a greater period of time. However, this again does depend upon whether you, as an investor, judge the best time to invest. For example, if you judge the market completely wrong, and let's say in January 2020, you decided to invest £100,000 into the stock market. Then the global pandemic hit, which caused the stock market to crash. Thus, you would have seen your investments plummet, and that would be devastating to see. Now, this is why the Vanguard paper did state that dollar cost averaging can act as a risk reduction strategy. However, historically on average, the trade-off has been a low return in the majority of stock market scenarios. As you can see from the study here, the historic returns of a systematic 12-month investment into a 60% stock, 40% bond portfolio showed that 68% of the investments, which were lump sum or immediate investments, performed greater than just 32% of the systematic or dollar cost average investments. This study was completed on the stocks of the USA, UK, and Australia. So the odds of your portfolio having better returns is increased massively by lump sum investing. So which is the best investing strategy for you? Well, it's clear from the Vanguard study and my own personal experience that if you have a lump sum of cash there ready to invest, then investing it in a lump sum is the best way to go for greater returns. As Warren Buffett says, time in the market is greater than trying to time the market. However, you must be aware of the psychological impact of doing lump sum investing compared to dollar cost averaging. And thus, you need an investing strategy and a clear mind. One of the most common ways to ensure great returns in the stock market is to buy and hold investments for the long term. As historically over time, the market always corrects itself after crashes. The stock market crashes an average of once every 10 years, and it does a market correction that is a minus 10% drop at least once a year. So don't worry when this happens. You just need to stick to your strategy and have a clear mind. From the dot-com bubble in the early 2000s to the financial crisis of 2008, the stock market has crashed multiple times, but it has always come back stronger. So the longer you're in the market, the greater your chance of seeing fantastic returns. Whatever your strategy, never invest what you cannot afford to lose. For example, don't invest any money which you need in the immediate term. That is, you need to pay bills with and use for your day-to-day living. Conversely, if you do not have a lump sum of cash to invest already, then dollar cost averaging is the way to go. As even investing just $200 a month out of your paycheck will allow you to take advantage of the compound interest. And thus, as Warren Buffett says, time in the market is greater than timing in the market. So don't wait for your pot to build up before you start investing. Investing small amounts also works out great as a beginner, as you can make your investing mistakes when your pot is small. As your portfolio grows and you have a lot more cash to deploy, you have to be very, very careful with your investments, especially if you're putting vast amounts into individual stocks. So which investing strategy do you prefer? Dollar cost averaging or lump sum investing? Let me know in the comments below. Want to know my favourite stock picks of 2020? Check out my playlist below, which includes many great stocks that I personally have analysed and invested in. Also, if you want a free stock worth up to £200, you can get one of those by signing up to the free trading apps using my referral link below. I recommend Trading 212 if you want to activate your account fast. And if you enjoyed this video, go ahead, smash that like button, and definitely subscribe. See you next time.
Coming in, yeah, flex. I just wanna win.